So Iran cannot defeat the United States in traditional war. So Iran came up with an idea. The idea of putting pressure on the financial system that has supported the US economy for more than 50 years. And if this system weakens, it could affect the US stock market, make everyday goods more expensive for American households, and accelerate the global trend toward de-dollarization. So right now the conflict between the US and Iran is creating pressure in the Strait of Hormuz. And whenever oil supply is at risk, global financial markets react, because for more than 50 years, oil has been closely connected to the US dollar. This system helped the United States become the world's largest economy in the modern history. And even small changes in how oil is traded can influence global demand for the US dollar. So the real question is not just about war. The real question is what happens if the world slowly needs fewer dollars to buy oil. So to understand why this matters, we need to go back in time, where the system actually began. So before 1971, the US dollar was backed by gold. Foreign government could exchange their dollar for physical gold from the United States. But during the Vietnam War in 1960s, the US government increased spending on programs such as the war and social policies. And to fund this spending, the Fed started printing more dollars. Other countries began to notice that the United States was printing more dollars than the gold it actually held. France was one of the first countries to act. They started exchanging dollars for gold. This created pressure on US gold reserve, and confidence in the US dollar decreases. So in 1971, President Richard Nixon made a historic decision. He ended the convertibility of dollars into gold, and this event became known as the Nixon shock. The dollar was no longer backed by gold, it was backed by nothing. So it became a fiat currency backed by the trust in the US government. And this created uncertainty in global currency markets. The dollar needed a new foundation. Then in 1973, another major crisis occurred. The Yom Kippur War began in the Middle East. The United States supported Israel, and in response, several oil-producing countries restricted oil exports to the United States and anyone supporting Israel. Oil prices climbed to 400%, inflation increased, and unemployment at 9%. US stock market experienced significant volatility. During this period, Coca-Cola fell nearly 70%, and Polaroid, the AI stock of that time, dropped more than 90% from its peak. So this crisis showed the United States how important energy security was for economic stability. And oil was not just a fuel, oil was an economic power. So in 1974, President Richard Nixon sent Henry Kissinger to Saudi Arabia with an important deal. And the deal was like this. Saudi Arabia would sell oil in US dollar, and in return the United States would provide military security and weapons to the Saudi Arabia. Saudi Arabia accepted a deal, and other oil producing countries followed the same route. And this created the Petrodollar system. And under this system, any country that wanted to buy oil needed US dollar. And this increased global demand for the US dollar. As long as the world needed oil, the world needed dollars. And this supported the growth of the US economy, Wall Street, and US financial markets for over 50 years. But the system didn't stop there. Oil exporting countries started earning billions of US dollar from selling oil, and they needed a safe place to invest that money. So a large portion of those dollars flowed back into the United States economy. They bought US Treasury bonds, which helped the US government borrow money at low interest rates. They invested in US stock market like the S&P 500 and Nasdaq. They invested in real estate and other US assets. If you own an iPhone or invest in index funds, there is a good chance that part of that money comes from oil exporting nations. This cycle is known as petrodollar recycling. Money flows out to buy oil and flows back into US capital markets. And this helped keep treasury yields relatively low. Lower yields helped keep borrowing costs lower. And for the US government, businesses and consumers, this supported economic growth, stock market expansion, and asset prices. Now let's look at what's happening in 2026. Iran understands that defeating the United States is extremely difficult and it's impossible. So Iran is targeting the petrodollar system, and to give China an advantage, Iran is pushing oil trade to be settled in Yuan, a Chinese currency. This means countries that want oil may need Yuan instead of dollar. And countries are desperate for oil because their factories, cars, and businesses all depend on energy. So on 15th of March 2026, report showed that some oil trade was settled in Yuan, and a Pakistani tanker passed through the Strait of Hormuz. This shows how China could benefit if more oil trade moves toward Yuan. Right now, only a small portion of oil trade is happening in Chinese Yuan, but even small changes can signal a bigger shift. If more oil trade starts happening in Yuan instead of dollar, global demand for the US dollar could slowly changes. And the Strait of Hormuz is one of the most important oil routes in the world. Nearly 20% of global oil supply passes through this narrow choke point. Today, many countries hold large reserves in US dollar because global trade has mostly been done in dollars. But most countries don't keep billions of dollars as cash. They store that money in US Treasury bonds because they are considered safe and liquid. Now imagine this. If a country needs Yuan to buy oil, they first need Yuan reserve. And to get Yuan, they may need to sell some of their US Treasury bonds. When they sell those bonds, they receive US dollars. And then they exchange those dollars for Chinese currency, that's Yuan, in the foreign exchange market. And with that Yuan, they can pay for oil. If more countries start doing this, demand for US treasuries could slowly decreases. And when demand for US treasury decreases, interest rates may increase. Higher interest rates can affect mortgage rates, businesses loans, and stock market valuations. This is why the petrodollar system matters. And right now the United States has around $39 trillion in national debt. And in 2026 alone, the US government is expected to pay more than $1 trillion every year just in interest on that debt. So for decades, the petrodollar system helped the United States borrow money more easily. Because many oil exporting countries earned billions of dollars, and they invested a large part of that money back into the US economy. They bought US Treasury bonds. This helped keep interest rates lower, and lower interest rates made it easier for the US government to borrow money at low interest. and lower interest rates made it easier for the US government to borrow money. Now here where the risk comes in. The US government collects about $5 trillion in taxes every year, but it spends about $7 trillion. That means the government spends $2 trillion more than it earns every single year. And to cover this gap, the government borrows money by issuing Treasury bonds. And in 2026, around $9 trillion of existing US debt needs to be refinanced. That means the government needs new buyer to purchase that debt again. Usually investors, banks, pension funds and foreign countries buy these bonds. Large financial institutions like JP Morgan and Morgan Stanley also help distribute this debt to the market. But what happens if demand for US Treasury bonds becomes weaker? To attract buyers, the government may need to offer higher interest rates. And higher interest rates affect the entire economy. Mortgage becomes more expensive, car loans becomes more expensive, business loans become more expensive, and when borrowing becomes expensive, companies may slow down expansion. Some companies may hire fewer workers, some may reduce investment, and higher interest cost can also pressure stock market valuation, including companies in the S&P 500 and Nasdaq. Businesses may also face higher cost for material and refinancing, and when costs rise across the economy, economic growth can slow down. This is why global demand for US debt matters. If global trade slowly becomes more diversified across currencies, long-term demand for the dollar could gradually change. And that could influence interest rates, financial markets, and economic conditions in the United States. Some countries are exploring alternative trade settlement systems outside the dollar. Some central banks are increasing gold reserves. Some economies are experimenting with multi-currency trade agreements. And these developments do not mean the dollar will disappear. The US dollar remains the most widely used currency in global trade. US capital markets remain among the deepest and most liquid in the world. The Federal Reserve continues to play a major role in global monetary conditions, but the global system may gradually become more diversified over time. In the long term, changes in currency demand can influence exchange rates. A weaker dollar can increase import prices. For American consumers, higher import prices can contribute to inflation. Interest rates may adjust depending on global demand for the US debt. Changes in financial conditions can affect mortgage, businesses, investment, consumer spending, and retirement portfolios. This is why macroeconomic trends matters for long-term investors. Understanding how energy markets connect with currency system helps investor better understand global risk. So the key idea is this: global financial system evolves slowly. Major changes rarely happen overnight. But long-term trends can influence markets, interest rates, and investment returns. And understanding these global macro trends helps investors make better long-term decisions. So I am Jack Cross, and on this channel we connect global events with the US economy, financial markets, and your investments, helping you understand how global shift can influence your portfolio, wealth, and financial future.